What was that last part about me? Oh, nothing. Now, as you can see, I made a chart, and the chart has the federal funds rate in gold. What? You can't talk to me like that. You know I can read. I was out of town and you did not make a single trade. So there. Now, back to what I was saying. The federal funds rate is in this yellow line in this chart that I made. We have these candles here, that is crude oil. And then we have these candles here. That is the S&P 500 ETF called SPY. Now, as we can see, whenever the Federal Reserve cuts rates, what usually happens is we have economic pain afterwards. You can see it here with the dot-com bubble crash. You can see it here with the 2008 financial crisis. And you can see it here right before the lockdowns with COVID. And you can see it potentially happening here. And as we know, the Fed had just cut by 50 basis points. What we might be able to expect is a small little rally like we saw here, and a small little rally like we saw here before the crash. So as you can see, the Federal Reserve cut 25 basis points right here in the 90s when things were less turbulent. They cut 50 basis points for the dot-com bubble crash. For the 2008 crisis they saw coming, they cut by 50. By the way, they started cutting when Bear Stearns started to go under. It wasn't until a year later when Lehman Brothers crashed, which means they potentially cut too soon here. As you can see, there was this huge rally in oil, along with a small little rally in the stocks before eventually coming down until major capitulation right here. So they may have reignited inflation a little too soon, made oil super expensive, which ultimately led to something breaking all at the same time, which was the mortgage-backed securities. As you can see over here in COVID, you had a 25 base, and then when the lockdowns started happening, we had a 50. The fact that we have a 50 now is seen as fairly aggressive. That's kind of an issue because that may mean that they see something coming that we don't. If oil starts to rise again because inflation hasn't been taken care of, that could be a big issue down the road, similar to 2007. All right, so now let's take a look at a little bit of economic data, shall we, Mr. Wolf? Yeah, let's do it. Okay, so as we can see right here, we have core PCE that came in last August 30th. And year over year, it was 2.5%. If we go down, CPI, inflation year over year was also 2.5%. But the core minus food and energy was 3.2. So arguably, the 2.5% are closer to what the Fed's target is. But if you get rid of the volatile items like food and energy, everything else is more expensive at 3.2, whereby the CPI is mostly concentrated in urban environments. So inflation is arguably not even squashed yet. But that's the issue. We are probably going to have stagflation. The conservatives argue that we do not have inflation under control yet, and it will be reignited, and they are cutting way too soon. The liberals are complaining that they didn't cut soon enough because we have pain in the job market and rising unemployment that could spiral out of control. Either one of those extremes we do not want. Okay, so now we have a chart of FedEx, the shipping company, ticker FDX. As you can see, their stock just dropped off a cliff a few days ago. 11% or so, I think the drop was. This implies that the consumer isn't buying and people are not having things shipped, or else they are using less expensive alternatives such as the Postal Service or UPS. That is kind of a problem because I manufacture a lot of the conveyor systems that they buy from us. So that is definitely a sign that the economy is not doing very well, which is a sign that rates should have been cut as far as saving the job markets. You know what? I thought this was supposed to be a stock comedy channel. This is so deep and depressing. Where's the comic relief? Why don't you go take a look in the mirror? What? You can't. That's mean. I am the Wolf of Wall Street. I know everything. Just for that, I'm gonna bite your ear off. No, you won't. You don't have any teeth. What happened to them? I told you to brush them, but you wouldn't listen. Now they're all gone. You know what, Mr. Wolf? I bet you if we looked at the meme stocks, that would cheer you up a little bit. Yeah, let's go look at the meme stocks. All right, so let's look at the option chain first. As you can see with AMC, we had a quad witching expiration today, September 20th. The price closed just shy of all of these options going into the money. However, next week, you can see there are a whole bunch over here that could go into the money and cause a gamma ramp as well. Up to the sixes potentially, which would be pretty awesome. Everything does you kind of bullish. Now, when you keep on scrolling down, there isn't anything mind-numbingly amazing, but it's not bad. The same thing when we look at GameStop, GME. If we scroll back up to the top, you can see that we had our quad witching September 20th expiration. We had the price go up to about 21.50, 22-ish. And we had some bullish bets at the $30 strike that unfortunately did not go in. It's certainly not a bad option chain, but it isn't anything mind-numbingly, blatantly obvious as far as the skew goes, like when Roaring Kitty came back. If you keep on scrolling down, it's the same kind of story. It looks good, but it's not mind-numbingly crazy. Now, when we get out of here, we can look at some of the actual charts. For example, if we bring in the AMC chart, we can see that we have a whole bunch of gaps that could still be filled eventually. All of these. This gap, however, does not exist in other charts like TradingView because Fidelity did kind of a strange thing where they went and after the ape conversion, they did not adjust the chart. So this gap does not exist technically in other brokerages. If we go back to the charting, as you can see, we are trading in this wedge that we could very well break out of. Our volume is starting to come back a little bit right here at the very end of the day, mind you. And when we go back to other indicators, you can see that on the longer time frame, our OBV is still high. RSI has cooled down a teeny little bit at the very end, which is good. However, the ADX looks like it might cross bearish. So we'll see what happens there. As far as the Bollinger Bands, those continue to remain skinny in the long term, and especially on the longer time frames. As far as the stochastics, RSI is still a little hot. Oh, that's in a longer time frame. You don't want that. Let's go back here. RSI is a little hot, but it's cooling a little bit. It went down to the 40s, 41 just a day ago. Stochastic RSI and stochastics are down, which means we could see a little bit of a pump. The EMAs, moving averages, we had her going across here on the 1 minute. If we go to the monthly, it is still coming down. It's not going to have to go far in order to potentially use the 200 as support. If we go to a smaller time frame, like the 60-minute, you can see that it's even lower. We retested the 50 today at the top of this wick. All right, so when it comes to GameStop, ticker symbol GME, things are looking pretty good. On the monthly daily chart, we have a massive volume candle right here. That's really darn good. Our MACD looks like it's going to cross back on over, and our ADX is going to go green. DI plus is going positive. If you look at the Bollinger Bands, they're still skinny and they might contract as we keep on moving back upwards. This could mean a move is coming. If we look at the stochastics, things are looking pretty good. Plenty of room to move. RSI is neutral though. When it comes to the moving averages, the 50 is still above the 200. We still have that going cross coming on, and the wick almost retested the 50-day moving average. This bullish engulfing right here, that signifies some decent strength. If we come back and look at the gaps, we didn't quite fill this gap today, but that would have been quite a ways to go if we did. Monday, I expect that hopefully that should get filled. We did break out of this wedge, and we have a smaller channel that we could come back down to retest, potentially, on the bottom of that blue line. If we zoom in a little bit to the 6-month chart, we can see that this price is around $21.